So this is a case study for the value add strategy. And the location of the property is in Miami. So I entered this deal with 5 other partners. So this is a JV deal, joint venture. Oh, wait, okay, here. So here's some basic information on the building. Purchase price 2.1, down payment 500K. So we raised 500K among the partners. So this is just strictly no bank involved in this transaction, which is a huge plus because not having to jump through the hoops, deal with the loans and mortgage. The remaining is seller financed for 3 years. So it's a 36 months balloon. So the rehab is estimated to be 120K. So the backstory on this building, the previous owner, it's an older couple. I think they're in their 60s. They own this building for almost 30 years. And it's like half charity work, because like the tenants there, they've been there for so long, and the landlord just didn't want to raise rent. And then they have another kind of like a religious, it's not the church, like a Hindu temple type of thing in there. It was using the facility for free. So there's a huge value add opportunity in this. So I'll now show you the numbers on that. So it's 18 units, 10 bedroom and 8 efficiency. So as you can see, like at purchase, the average rent for the 1 bedroom is $600 when market rent is $1,050. It's actually higher than that because we started to turn this units over, and we're actually getting higher than that. So these are the underwriting numbers before purchase. Some of the units are paying like $350 a month just because it's been so long and so many years and the rent never went up. So it has like $800, $900, value add potential. And you can see in the picture, there are 2 storage units. So one of the units, it was like a Hindu temple in there. It was being used for religious services, but it was just like free. So yeah, so we're not doing that for free, right? So and additionally, this building also comes with a piece of land which is across the street. And so depends on where you are, right? So like in Miami, land is very valuable. So that land is valued to be 400 to 600K just on the land. This with nothing on it. So okay, so here's the
You might be getting to this, but I'm curious. So like with the rehab estimate of 120, that works out to, I think, like 6,500 or so, like per unit. Were you guys just doing like paint and floors, or was it divided up differently?
So that is to turn every single unit. So like I said, the tenant's been there for a long time, and it's, these people, they had this building for almost 30 years. So it's really just not being updated. So this is to turn every unit plus to convert the storage unit to add 2 additional units. So make it 20 units. Okay, so I want to talk a little bit about value add. By definition, right, value add is to buildings need corrective action to reach their full potential value. And if you read the article Marielle sent out, this picture is in there. So when you look at different type of building, right? So there are like so-called class A performing, like the core type of building. You don't really need to do any work, but usually they also sell at the premium, right? Because people already did the heavy lifting. So now they're trying to get their money out and then get a profit out of their work. So this is why, the value add is, it's a good, like a good deal, like people like it because you have the potential to, um, to increase your equity by pretty significantly, just depends on the deal. So typically like for core plus, I think it's more like stabilized and you just cash flow from month one, but it may not be a lot. It just depends on, the type of building. But definitely value add is the one I think you can get the most equity out of the deal if done right. Okay, and so some numbers. So I just want to show, I'm not gonna go into like the deal. I really want to talk about value add aspect of it because I think we're talking about strategy here today. So I want to show you, so this is basically the rent roll. So like I said, you see how some people are paying like $300 a month in Miami, which is probably because they've been paying that since 20 years ago and then just never got a rent increase. And the gray area is kind of like a renovation plan. So we are taking units offline, meaning we are moving people out, like one or two at a time. This is the plan when doing underwriting. So the plan was to take the units offline two at a time and finish the whole value add process within the first year. So we are a little behind on it, just because we had run into issue of with the pandemic and people not moving. So these are the things you always have to kind of budget when you underwrite a deal. So luckily, I mean, we're okay. We are covered, but we are gonna be behind. We're not gonna finish this at month 12. I think it's probably more like month 18. So what I want to show you is, okay, so if you see the yellow blocks, right? So we're looking at by turning the units and updating them and bring the rent to market, we are gonna be able to increase the rent by almost $10,000 a month, which translates to $120,000 a year. Additionally, we're converting the two warehouse spaces to make two additional units. And then we are exploring the options for the land. So we have like, look at like maybe make it a parking lot, just charge, parking fee, selling fireworks, pumpkin patch, Christmas tree lots. We're talking about putting food trucks there, just like, kind of explore different options. But I think the latest we talk about is actually putting containers and just make them storage. So one of my partner is looking into that, and we'll just see, if that works out.
One of the women in the group, just FYI, did put food trucks on her land by their office or something, and I think they made a bunch of money with it. So if you wanted to connect with her and ask her about it, figured I'd put that out there.
The thing is, like, I feel like there's a lot of potential with the land, but with everybody being so busy and then we're turning the units, we just haven't got around to it, right? So the sooner we can do something with the land, it's just more income. So that would be good. So right now it's just like nothing. It's just
so many options. Fireworks, I love it. You guys are just like all over it with the brainstorming.
So the property manager also gives us like recommendations because he's there, he knows how things work and like what's gonna work and what's gonna work for that neighborhood. So again, it's just very important to have a good property manager. So okay, next slide. I don't know why I keep getting stuck on my slide. I can't go to the next one. So let me stop share. And then do that.
If you like minimize the PowerPoint and then maximize it into slideshow again, will it still do that?
Let me see. Oh, wait, I can do this. There we go. Okay, so I want to talk a little bit about, can you guys see it?
Not yet.
Oh, okay. Can you see it now? But I think this is gonna mess
Yeah.
up okay. So I want to talk a little bit about the cap rate because you can't really talk about value add without understand the cap rate. So basically this is like a really just on the basic level. You see the formula here. It's a way to calculate your return on investment, right? So usually the cap rate is calculated by dividing the net operating income by market value. And then, so I have a little exercise here. So let's calculate the value of this building here. So at cap rate, at 5 cap, right? And with net operating income of 50K. So like what would the value of the building be?
Who wants to go? Is it Brenda?
1 million.
That's
Okay,
what I
so
got too.
1 million. Okay. And what about, so now, okay, so for the same building, right now we have made improvements, increased rent or cut expenses, whatever the case may be, we're able to increase our NOI by $10,000. So same building, same cap rate, income goes up by $10,000. So now calculate the value of the building.
1.2.
1.2 million, right? Is
Yeah.
that what you get? Okay.
Yeah.
Okay, I'm sorry, I can't. When I was, okay, I think
Maybe
I
you
can.
could save it as a PDF and scroll through it instead.
No, I'm just not gonna put the max. I think max the screen is mess it up.
Mhm.
So so I made some graphics. That's why I want. So anyway, so the point here is, as you can see, right? Like if you increase the value, I mean the income by $10,000, the value of the building goes up by $200,000. Like, does that make sense? I know this is very simple and this gets a lot more complicated, but I want to show you this formula with simple numbers and to show you why people like value add deals and why it is so powerful to to do commercial real estate versus residential.
Yeah, that's a really helpful example, Lupe. Thank you.
Yeah,
It was
so
fun having an activity in there. We should like make that a habit.
so this is just a little like $10,000 is very easy to achieve, right? Like you can, I don't know, like increase the rent even by $50 per door or just cut utility. Any little thing can, it's not hard to get to 10,000. So imagine in this case, right, if we're able to increase the rent just by rent alone, this is not talking about the warehouse space or the land, right? Just by rent alone to increase the annual income by $120,000. So how that would translate to a huge increase on the value of the building, both for sale or refinance. So when you refinance the bill, I'm sorry?
Did you pick the cap rate of 5% or where did that come from?
Oh yeah, I'm sorry. That depends on the market. So that's really market dependent. So for Miami, it's about like a 5.5. But every market is different. And it goes back to Timmy's point. You have to understand your market and just know like important things, right? The cap rate, price per door, some of the common like insurance cost. Like in Florida, generally insurance are higher just because of the hurricanes and the weather. So that is like something you would be higher in Florida compared to other markets. So this is it's the same kind of table to show you value add over the course of 3 years. So as you can see, right, down payment 746. So that is the down payment, the 500K plus rehab. Oh, so for rehab, how we funding rehab is the rent. So the rent is collected every month, right? Like right here, this amount right here, 8,000, the monthly total, right? So the rent is going back to the building. So basically, we are not taking any distribution for the first 12 to 18 months. So I guess this, Marielle, to your point, right? You want a cash flow on day one. So this is like, this is the case of you're not gonna cash flow for the first 12 months. And then we probably, hopefully, you know, cash flow, you know, by like maybe month 15. But for now, we are putting all the money back into the building. So, but the benefits, we don't have to raise additional capital for the rehab. So it's kind of like the building is feeding itself on the rehab. So that's the benefit of it, because otherwise we would have to raise additional capital to cover the rehab.
So you mentioned that you're redoing every single unit, and it looked like there was 2 units that you were starting off with in month 1. Did you guys just fund those yourself to start off, and then once you collected the rents from all the other units, then you used it to pay for the other rehabs?
Yeah, we had some extra money. So like when we closed, I think we had about 70,000 or so in the bank, just because we had raised a little extra to cover that. But after that, everything is coming from the rent. But you always want to raise a little extra, right? Because you need to have cushion, you need to pay bills. And so for a building like this, you know, everything like insurance, utility, everything is a lot higher than a single family home. So you do need to have that like some money in the bank, even at closing, just to cover expenses. So here's an example of an investment of $50,000. So basically, at the end of the 3 years, right? So 50,000 is translate to like 8.39% of the partnership, and at year 3, when the building is refinanced or a sale, basically you would, for this investment, you know, the equity, meaning that is a sale or gain from sale or refinance, is going to be around $45,000, and then annual cash flow at $5,000. And then if you add these 2 numbers together and divided by 3, you get an annual return of $20,000. So the total return on year 3 is estimated to be $111,000. Well, that's including the initial investment. So, and then also, hopefully, we will cash flow at about month 15. I think that's what's probably realistic right now, looking at completing the rehab in month 15. So we closed on this building in November last year. So it's been about 8 months now. So we hope to finish everything in about another 7 or 8 months.